As the U.S. market session for Monday, November 17th, 2025 has just concluded, Rezolve AI PLC, trading under the ticker RZLV, has closed at $2.72 per share. This represents a significant and painful intraday drop of $0.23, wiping out 7.71% of its value during today's session. This isn't just a minor fluctuation, it's a statement from the market, and the immediate question is, why? Why is a company that just weeks ago was touting blockbuster guidance and new executive hires from giants like Apple and Google bleeding out on a day like today? This is where the simple narrative that many investors have been fed, that Rezolve is the next big AI play in e-commerce, collides head-on with the much more complicated reality of its financial position and the intense volatility that defines this particular stock. The general belief, the expectation, is that Rezolve AI is on a clear upward path. You look at their investor relations page, you see the news. They recently raised their 2025 annual recurring revenue, or ARR, guidance to a very impressive $150 million. They even initiated a 2026 guidance target of $500 million ARR. They talk about agentic commerce being the future, a sentiment they happily pointed out was recently echoed by Amazon's own CEO. This creates a picture of a company firing on all cylinders, a small-cap disruptor that's about to start competing with the giants. You see the Nvidia stock-like ambition in the AI space, and you think a $3 stock is a bargain. But the reality, as shown by today's 7.7% drop, is that this stock is not trading on its 2026 potential. It's trading on its 2025 precarity. The reality is that this stock has been in a near total free fall for the last month, down a staggering 47% in that time frame alone. Today's drop isn't an anomaly. It's a continuation of a brutal trend that has seen the euphoria of its last earnings report completely evaporate. Let's look at the mechanics of today's move. What's fascinating is that this 7.7% decline appears to have happened on relatively light volume. We're seeing figures around 128,000 shares traded, which is a fraction of its average daily volume of over 12 million shares. This is critical. A heavy drop on low volume doesn't suggest a mass, panic-driven exit. It suggests a lack of bids. It means the sellers, however few, had to drop their prices significantly to find any buyers at all. The buying pressure that held this stock up has, for now, simply vanished. This is not the kind of healthy price discovery you see in Tesla stock or Apple stock. This is the sign of a highly speculative ticker where liquidity can dry up in an instant, leaving holders stranded. This is precisely the kind of volatility that makes this stock a favorite for quick trades on the Robinhood app, but a nightmare for anyone looking for stable online investing. This stock is a battlefield between retail enthusiasm and institutional maneuvering. The retail side, often engaging in self-investing through platforms like the SoFi investing app or the Fidelity mobile app, sees the AI label, the low price, and the huge guidance. They see an opportunity to buy fractional shares of what could be the next big thing. But the institutional side is playing a different game. Recent filings show that institutions have been piling in, a massive 300% increase in institutional shares held in the last quarter. But look at who is involved. Names like Citadel, Susquehanna, and Jane Street. These aren't typically buy and hold investors. And when you look closer, you see many of these firms are holding both significant call and put positions. They aren't betting on the company, they're betting on the volatility. They're using sophisticated tools on the interactive brokers trading platform to profit from these exact 7 to 10% daily swings. This isn't an asset for Fidelity Wealth Management to place in a retirement account. It's a trading vehicle. The catalyst for this entire volatile period was the company's last earnings report back on October 1st. And this is where the expectation versus reality disconnect is clearest. The headline was that H1 2025 revenue was up 426% year over year to $6.3 million, which beat consensus. The company's gross margin was an incredible 95.8%. And of course, they issued that massive $150 million ARR guidance. The stock exploded over 21% in pre-market trading on that news. But here's the reality buried beneath the headlines. The quarterly revenue for Q2 missed analysts' forecasts. The company posted 4.88 million against an expected 6.75 million. That's a significant miss. Furthermore, the company's wildly unprofitable, with a net profit margin of over negative 4,000%. They are burning cash at an astonishing rate to achieve that growth. The market, in its initial excitement, completely ignored the revenue miss and the cash burn and traded only on the 2026 guidance. Now, 6 weeks later, the hangover is setting in. The excitement has faded, and investors are left holding a company that, while growing, is also missing its near-term targets and is substantially diluting shareholders to fund its operations. Today's 7.7% drop is the market recalibrating its expectations back to that underlying reality. So, what does Rezolve AI actually do? Its core business is an AI-powered e-commerce platform it calls the Brain Suite. This includes Brain Commerce for product discovery and Brain Checkout for simplifying online payments. The idea is to use AI to make the shopping experience more personal and reduce the number of abandoned carts. This is a legitimate and needed service. The business model is primarily subscription-based, SaaS, and also takes transaction fees. The entire bull case rests on this model's scaling and scaling fast. A massive part of this scaling plan hinges on its key partnerships, especially with Google. Rezolve has stated it expects the Google Cloud sales channel to generate more than half of its forecasted revenue in the coming years. This is a massive opportunity and a terrifying dependency. If that Google relationship flourishes, the 150 million ARR target looks possible. If it sputters, or if Google's priorities change, Rezolve's entire growth narrative could fall apart overnight. This isn't like Fidelity offering Fidelity ETFs that track an entire index. This is an investment in a single, high-stakes relationship. This is a company with a market cap of under $1 billion, $950 million, that is guiding for $500 million in recurring revenue in just over 2 years. That is an incredibly bold claim. To put that in perspective, they just reported a quarterly revenue of under $5 million. The leap from $5 million in a quarter to an exit rate of 500 million ARR is astronomical. It requires flawless execution, a booming economy, and for all of its partnerships to fire perfectly. The market is increasingly skeptical. Add to this the other risks. The company has a reported Bitcoin-backed treasuring strategy, which introduces a completely separate layer of volatility tied to the Robinhood crypto markets. Shareholders have already been heavily diluted, and with the company burning cash, more dilution is on the way. This isn't a stock you park in Fidelity IRAs or a managed intelligent portfolio. This is a stock for active traders who understand the risks of SoFi active investing and are willing to lose their entire position. This brings us to the future outlook, and the tension is palpable. The bull case, the expectation, is that the selling over the last month is a massive overreaction. The bulls will say the market is foolishly focusing on a single quarterly revenue miss while ignoring the 426% annual growth, the 95% gross margins, and the world-changing $150 million to $500 million guidance. They'll say the new hires from Apple and Google validate the tech. They'll look at analyst price targets, which range from $7 to $15, and see a stock at $2.72 as a multi-bagger in the making. They'll continue to use their Fidelity brokerage or Robinhood stock trading accounts to buy the dip, believing this is the bottom. But the bear case, the reality, is that this stock is a house of cards built on projections. The bears will point out that the company itself said there's a 7 to 9 month lag in converting that ARR guidance into actual collectible revenue. They'll say the 150 million is just a number on a slide until it shows up as cash. They'll point to the negative PE ratio, the extreme unprofitability, and the high-risk dependency on Google. They'll see today's 7.7% drop on low volume as a sign of the last of the believers are giving up, and that the stock is now in a vacuum, with the floor nowhere in sight, potentially heading back to its 52-week low of $1.07. This is the kind of investment help that's hard to hear but necessary. The story is fantastic, but the numbers are frightening. Many investing sites might promote the story, but the financials tell a different tale.
So here's the question I want to pose to everyone watching. Comment below. Do you think Rezolve AI can actually hit its 150 million ARR guidance for 2025? Or is this all just smoke and mirrors from a company burning through cash? In the end, Rezolve AI is a perfect case study of expectation versus reality. The expectation is a disruptive AI powerhouse, a ground floor opportunity in a multi-trillion-dollar market, validated by the biggest names in tech. The reality, at least for today, is a sub $3 stock that just lost another 7.7% of its value, is down 47% in a month, has microscopic revenues, staggering losses, and is being used as a high volatility playing thing by major institutional trading desks. The story is about 2026. The stock price is about today. And today, the market is voting with its feet, deciding that the promise of tomorrow isn't worth the price of holding on right now.